Welcome to the Allan Small Financial Show. As always, I want to thank everybody for taking time out of your busy day and spending some time with us. We have another great show for you today, answering many questions that I've been receiving over the past couple of weeks. We're actually going to get into a number of individual stock ideas, probably more stock ideas than we normally get into. So, for all of you that are watching today, perhaps take out your pens and maybe take a look at some of the names that we're going to be talking to you about, some for good reason and maybe some for not so good reason. We also have a great guest on our show today, Pedro Antunes. He is the chief economist for Signal 49 Research, formerly the Conference Board of Canada. He's going to talk to us about everything to do with the Canadian economy, all things to do with that, and basically talk to us about what it's going to take to get the Canadian economy kicking into a higher gear. We've seen to be flatlining for quite some time now. And, arguably we are in a technical recession, perhaps just came out of a technical recession. So a great interview with Pedro Antunes from Signal 49 Research, and that's coming to you right off the top of the show. But let's see what other topics we have on our show today. There you have it. Snapshot of the Canadian economy, productivity and trade. Pedro Antunes, Signal 49 Research. As always, we are then going to move to our top three things to consider over the next 5 to 10 business days. These are three ideas, very popular part of the show, three ideas that investors should be focusing on when you make your investment decisions. Certain market leaders have been seeing some sell-offs. We've seen it in a few areas, but mostly in the semiconductor area, the memory chips, the storage names, the server names, as an example, and it's been pretty pronounced over the past month or so. We're going to talk a bit about that. Watching technology earnings. We're going to kick off earnings tonight with Alphabet. We have also earnings from IBM, Texas Instruments. So a number of tech names starting off the earnings season. Very big night tonight. It will start just after 4 p.m. when the markets close. We will get earnings from some key tech names. Quick hits. Three things I've seen in the news over the last couple of weeks that I wanted to comment on. One that just came out very recently, that is this whole idea of the President Trump putting on another 50% tariff on goods coming from Canada to the US. So we're going to touch on that. And last but not least, your questions. If you have any questions during the course of the show with respect to what our guest is saying on our interview or during our interview, or any questions regarding anything that I've said on our show today, please put them in the chat boxes. Put your questions in the chat boxes wherever you're watching this show from. We will come around and pick up those questions and either answer them at the end of our show today, or we will get to those questions on our next show, or perhaps even I may answer them throughout the course of the next couple of weeks. So without further ado, let's move on with our fantastic interview with Chief Economist for Signal 49 Research. Welcome Pedro Antunes, Chief Economist, Signal 49 Research, formerly known as the Conference Board of Canada. Pedro provides strategic direction to this applied research organization, which delivers economic research, reports, and forecasts about Canada, its regions, and key sectors. Pedro also shares his expertise before parliamentary and Senate committees, in media interviews, and in presentations to industry leaders and decision makers across Canada. Welcome to the show, Pedro.
It's a pleasure, Allan. Thanks for having me.
Thank you for joining us. And, we get a lot of questions from individual investors, a lot of investors asking questions. How is the stock market going up when the economy doesn't seem to be doing so well? A lot of people feeling the pressure that higher costs bring, that some job loss has brought over the last year, et cetera. And so who better to talk to us about the state of our economy here in Canada than yourself? And I thought we would start off kind of a general question for you this afternoon. So the Canadian economy, in my opinion, has been quite weak over the last 6 to 12 months. We've seen very little growth in GDP. The jobs data has been quite volatile. At one point, we saw 1 month higher, 1 month lower, and that was a bit of a pattern for a little while this past year. As you know, recently there's been some debate whether the Canadian economy is in a technical recession. Some people say no, some people say yes. Then in April, we had I guess, some stronger GDP growth, 0.5% growth for the month of April. About almost half of that was in the oil or due to the oil sector. We've also received back-to-back positive jobs data the last couple of months. So with all this topsy-turvy data, what do you think is going on with the Canadian economy? How, in your opinion, or what's your view on the state of our economy here in Canada?
Yeah, well, Alan, I guess first of all, I'd say we are still a small economy in the sense that we have sizable industries that have and can cause swings in some of the monthly numbers that we see out there. So my first suggestion would be careful around the monthly numbers and take a look at the trends. But having said that, we are not in, Canada is not doing well in terms of its economic outlook or in terms of the past number of months, as you've mentioned. In fact, we were in a technical recession. We define a technical recession as 2 quarters of declining growth or declining GDP. And that's what we suffered through the fourth quarter of 2025 and the first quarter of this year. I don't personally like the way we define a recession in Canada. I prefer essentially what they do in the States, which is ex post. They go back and they kind of look at the monthly pattern. Have we seen a decline in jobs, in the level of employment in the country? And I think that's a better method. But if you use our definition, then yes, essentially GDP, real economic activity has been flat over the last 6 months. And as you mentioned, we are finally starting to see a bit of a pickup. Same goes for the labor market, really very weak, very flat performance over the last 6 months. And those are indicators that are important. Of course, job creation is really important to households in Canada. It's what drives, consumer spending, which is still a big part of the economy. Um, what else is going on aside from our domestic economy or what's happening with consumers? Well, it's the trade side that's, very concerning. We're still suffering in terms of our export performance, and exports are roughly 30% of our total economic activity. So, with this trade war that is ongoing with the US, this uncertainty around that, there's challenges essentially for some of our major exporters. And of course, that then tallies on to the investment side of the economy. And this is, again, that uncertainty around will we have access to the US market? And that causes a layer of essentially disinvestment or a lack of investment. And that when I say investment, we're talking about, greenfield, like on the ground purchasing capital, like physical capital, like machinery and equipment, investing in intellectual property, or building structures that add to our productive capacity. And we're very, very weak on that front. So I'm afraid it's not a great news story. We are hopeful that we'll see a recovery with more stability in trade if we get some agreement on CUSMA. And we're also hopeful on the investment side with a lot of the focus that the federal government has had on promoting private investment.
Yeah, and it's interesting, I agree. The picture is not that strong at all, fairly weak at times, and yet here we have a stock market at all-time highs. So I think there's the disconnect for individual investors. I wanted to turn to I guess GDP. You mentioned it. I talked about it as well. We frequently hear, economists talk about Canada's productivity problem, right? GDP per capita, definitely when you compare it to some of the other G7 nations, not as high. Why should investors, I guess, care about productivity? And what would you say, or I guess, what's one thing you would like government to do or businesses to do to over the next few years to address this issue of weak productivity?
Yeah, well, I personally, I like to go back to what is productivity, what is GDP. In fact, if we go back to what is GDP, GDP is essentially just income that is generated through economic activity. And there's two recipients of that income. One is the workers. So as we do work and as we produce things in terms of our labor, we receive labor income or wages, and that's one component of GDP. The other component is for owners of capital, those that own machinery and equipment or productive capital. they earn profits. So that's what GDP is. It's essentially income. And income per hour worked or income per person, it's really important because if we're doing well on that front, it's not that we need to work more hours, it's just that we're earning more for those hours worked. And that's what we're calling productivity, essentially. And so if we do better on that front, for the same number of hours worked, we earn more, be it profits or be it wages, then essentially that's our prosperity. That's our ability to purchase things, to purchase more. That's our ability to for governments to be able to tax that income and provide services. So it's a very, very important metric. And you're right, we've not been performing well, especially relative to the US. And so when I go back to the basic question, there's lots of reasons, and perhaps, there's things, we've heard a lot around investing in intellectual property or adopting more technology or being more, how should I say, more focused on entrepreneurial values, things like that. But I think if you boil it down to the basics, when we're talking about labor income, there's a really good example where we go back to essentially how much physical capital do we have per person per hour worked, and that is essentially comparing. A worker that has, for example, a snowblower, and this I go back to an example that was put out by the central bank, versus somebody who has a shovel. So if you have more physical capital, you can do more work and you can earn more income. And this is a clear lagging indicator for Canada. Our investment in physical productive capital, snowblowers, we're at about 11% of GDP, whereas the US is running at around 15%, and the US is the leader among developed economies in productivity. So I think that it's staring us in the face what the problem is. And then to get that investment up, I think there's a number of reasons. The major reason I think is essentially, we're a resource economy, and we've seen a lagging performance in terms of investing in the resource sector. And I'm hopeful that some of the policies that we're hearing about from the federal government and provincial governments as well will help lift that. But for now, that remains to me the big problem.
Yeah, all the things that our government is trying to do, pipelines and trade negotiations with, I guess, areas around the world, not US, to try and increase trade. I think that hopefully will help in that regard. Wanted to turn to the Bank of Canada, and we just recently got a policy announcement. It was no surprise they kept interest rates on hold, and I guess they're in tight or in a difficult spot, right? Because I guess headline inflation is well above target, although core inflation is kind of still at target, uh, which is 2%. Um, do you think the Bank of Canada should be looking more at, the inflation problem or the jobs growth problem and the growth problem? Because obviously they have that dual mandate. Do you think we would see the Bank of Canada cutting rates anytime soon to address issues of growth? When I look back to pre-COVID interest rate levels, they were actually lower than they are today, and our GDP was higher. So we had lower interest rates with higher GDP pre-COVID. Today, we have higher interest rates with lower GDP. So, I know the Bank of Canada says there's not much they can do at this point. They're kind of, leaving it to the federal government. But do you think the Bank of Canada could cut rates to stimulate some growth? Because we are seeing obviously a slow growth situation in our country.
Yeah, Alan, you touch on so many different issues there. That's I think we can reflect on a few things here. But one, I do think the bank is concerned about inflationary pressures. Back in 2022, when Russia invaded Ukraine, we saw a commodity price shock, an oil price shock. A lot of the central banks were calling that transitory. Let's not worry about it. It's transitory in the sense that it's temporary. But in effect, it bit into inflation more globally. And then for a number of years, we had essentially a lot of wage pressures as, essentially, workers were looking to reestablish their purchasing power. And so we saw wage pressures domestically. And it took a very long time for the bank to get, and central banks around the world with high interest rates, to get inflation back down to more or less their target. And just as we get there, we have this new situation with the Strait and another inflationary shock. So I think the bank is very concerned. I can't imagine that the bank would lower rates at the moment, given that the economy, even though it's weak, it's still ticking along. The other thing I'd like to say is the bank, it has control over the short-term rates that essentially it's the overnight lending rate, but that rate is the overnight lending rate to the chartered banks mostly. You and I, investors and consumers, when we go out to borrow, our rates are much more based on what's happening in the bond market and yield curves, right? And I think when you were mentioning something pre-COVID and where we are now, I think there's a very, very different picture around the amount of capital and where the kind of underlying interest rates are going to be set by essentially bond markets. And if we go back to pre-COVID, China was booming onto the world stage. There were massive amounts of savings that the Chinese had, and they were purchasing U.S. Treasury. So there's a lot of capital flowing into the global economy. This isn't a Canada story, it's a global story. And that was keeping yields, interest rates, the cost of capital really low pre-pandemic. Those days, I think, are gone. China is growing more slowly, and the world is much more indebted in terms of sovereign debt. So there's a much more demand now for capital. We hear the word crowding out, and I think this is what's happening, and this is why fundamentally interest rates are not going to get back down to those rates or those levels that we had pre-COVID. I think we're living in a world where at the very least, a 5-year yield at 3%, a 10-year yield at 4%, that's a minimum. And we haven't seen those rates come down, even as the bank has lowered rates here in Canada.
Yeah, I think we're in that higher for longer, I guess, as they call it. I want to talk about foreign investment as well. Obviously, foreign investment to our country is extremely important. Our prime minister has been traveling the world over the last little while, trying to bring in foreign investment into our country. So, kind of a few parts to this question. First, do you think we have the policies in place and that we've created the right environment to compete for business around the globe? And and if you do think so, or maybe perhaps not, we can do more. Why would someone open up a business here in Canada, in Ontario, or wherever we're living in this country, versus opening up that same business in the United States? What are Canada's selling points? We hear often the environment for business in the United States is actually quite good over the last few years, tax cuts, etc. Do you think we need to I guess maybe take a page out of the US playbook to become a little bit more competitive?
Well, I definitely think we need to keep an eye on what are the policies in the U.S. And when we hear from our federal government, we often hear about the marginal effective tax rate. I hate to throw jargon out there, but for corporations, and what that says is, at the margin we have fairly competitive tax rates. But if you include subsidies and other programs, when you look at the total tax take by government in Canada versus the US, we're at much higher tax rates or overall take here in this country. So there's a challenge there on corporate tax competitiveness for sure, and we need to keep an eye on that. But I think that there's bigger challenges, and one of them is this trade uncertainty. So when we're talking about manufacturing, within that North American market, we talk about the auto sector in Ontario. If we don't have the U.S. access to the U.S. market for manufacturing, especially for auto manufacturing, then we're not going to see the investments happen here. And I think this is part of the strategy in the U.S. Among the U.S. administration for President Trump is to create that uneasiness, that uncertainty to drive investments south of the border rather than here. And boy, that's a tough challenge for us, given the state of the diplomacy and policies between our two countries these days. The other, I think, big piece when you talk about foreign direct investment coming into Canada, often when I think of foreign direct investment, I think of the resource sector. We've seen in a lot of budgets in Ontario, federally, and of course among other provinces, how do we attract foreign investment into our resource sector? And there, I think the challenge, we're trying to address it. The challenge there is the review process, the uncertainty created by that review process, the multiple levels of government here, from Indigenous governments, provincial governments, federal governments. And I think the recent examples that we've had to showcase to the world have been things like the TMX pipeline, for example, where, the government had to buy that pipeline, and even then we couldn't get it, how should I say, built without all of the challenges that happened. It took years, extra years, and a lot of cost overruns before we got that project going. I think we're turning the page on that with the major projects office. If we can showcase some success here with some of these projects, I think the investment will flow back because we are, very, very strong on the resource side. We have, we are blessed with our resource sector, and the resource sector is very capital intensive. It drives up productivity. It's a sector that can have major payoffs and can drive a lot of activity in other sectors through supply chains, et cetera. So I think that's an important one for the FDI piece.
Yeah.
And if I could just add one more point, I do think on the manufacturing side, the federal government has, how should I say, tried to match the Great Big Beautiful Bill. If you might remember, we can write off our investments very quickly. I think we're trying to do some things there, but we don't want to be running deficits like they are in the US either, right? We've got deficits that are already running at 2% of GDP. The US, it's not sustainable. They're running 6, 7% of GDP. So I think we're in a better state, at least with respect to that.
Yeah, I know for sure. And it's, we've always tended to be a little more conservative when it comes to certain policies. The US seems to be a little more aggressive, running, like you said, obviously much larger deficits. I guess your answer to this question kind of leads me to my last question for you regarding Kuzma, right? The trade. Some experts are suggesting that Kuzma deal won't happen until after the midterms this year, or perhaps well into 2027. And I guess looking at your crystal ball, what's your view on the timing of a potential deal? I guess, do you think that we're moving slowly in the right direction towards a deal? And I will even add my personal opinion, which is, do we even need a deal at this point? Yeah, it brings certainty. It brings, I guess, another 16 years of having a deal in place. But I guess right now, all it means is that we have to renegotiate every year. And maybe that's not a bad thing. Maybe that is a good thing for us. I'm not sure. But obviously, we would like to have more certainty. But what do you think is going to happen with Kuzma? Do you think we're going to get a deal? And if so, is it going to be a deal that's good for our country?
Yeah, it's a big question, big question mark. I would say that well, first of all, when we look at the effective tariff, we are right to say, Prime Minister Carney is right to say that we have one of the lowest tariff rates among U.S. trade partners. Our effective tariff is around 3 or 4%. In 2025, the overall effective tariff from the U.S. was about 8 or 9%, roughly around that mark. So a lot of the products that we have that we sell into the U.S. are, obviously, aside from the manufacturing, metals, aluminum, forestry products, a lot of those products, the resource products for the most part, are going through the border tariff free. So we do have, I guess, some clout in these negotiations because the U.S., despite all of what they say, they absolutely need our resources. They absolutely need our oil, our uranium, our fertilizers, and I would say and argue that they still need our metal, our steel and aluminum. In fact, they're importing aluminum now, even with the higher tariffs, because they need it and they can't get it. There's a lot of aluminum being restricted because of what's happening in the Strait of Hormuz, not just oil. So we do have some clout. Where I worry about the negotiations, well, on the uncertainty, an annual review, I think is a problem for a lot of manufacturers. In fact, most manufacturers that I've talked to, all they want is certainty. They'll deal with the supply chains and the issues and the prices, and they'll deal with those things, but they need to know what is the tariff and how can they deal and manage to have that access to the U.S. consumer. So I think an ongoing review is going to be a problem for our manufacturing sector. And I think this is part of the strategy in the U.S. is to create that uncertainty, that upheaval to essentially attract and drive investment south of the border. And it's not good for Canada, and it's not good for our manufacturing bases in Ontario and Quebec. Again, all of this uncertainty, we have clout, but it's a challenge. And the last piece I'd say is, the federal government certainly has been focused and trying to push diversifying our trade. That's a challenge. It's going to take time, and we've tried to work some deals, and I think we'll have some success at that. There's a natural emphasis from businesses as well to look for other markets. But in terms of the negotiations, all of a sudden we're opening up trade with China and India and Europe more so, and the U.S. is telling us that they want to kind of create a North American kind of a fortress North America. So the policies here are diverging, and I do worry about how long it will take us to kind of get in back into the negotiations because we're not even at the table right now.
Yeah, talking to David Patterson down in Washington. I had him on our show talking to us about the latest. He says a lot of things, look worse than they are, that there are negotiations and talks on a regular basis. So hopefully we'll keep our fingers crossed we can come to some deal. Pedro Antunes, Chief Economist, Signal 49 Research. I want to thank you so much for being on our show and talking to us about the state of our country. And we get a lot of mixed signals, as I said right off the top of the show. And it's always great to have someone like yourself on the show to make sense out of everything, give us the goods, as we say, the data, and as I said, for investors to be able to understand how our country is doing, and to I guess build a portfolio, an investment portfolio that takes advantage of our strengths and hopefully avoid some of our weaknesses. So thank you once again for being on our show.
You're welcome. It's been a pleasure. Thank you.
Thank you. Fantastic with Pedro, and so knowledgeable, sharing that knowledge with us about what he thinks we need to do as a country to improve our GDP. We talked about a lot about resources. He feels that is the key to unlocking a lot of the growth in our country. I think many would agree with that. And of course, we got to keep an eye on our neighbors to the south to remain competitive with the United States. So now we come to a very popular part of our show, top three things to consider over the next few weeks before you make your investment decisions. And as always, we have our three things up for you to take a look at, for us to go through on our show today. Oil prices climb. We have unfortunately started to see oil prices climb once again. The conflict in the Middle East has definitely begun to heat up once again. We've seen missiles flying from Iran, from the United States, bombings, bridges being blown up, etc. This has caused the price of oil to spike higher, and the blockade again is been put in place by the United States. So nothing from Iran is being able to get out. Oil is not being able to get out of the strait, and Iran is not letting things come out either. So we're going to talk a bit about oil prices climbing. Expectations too high for certain stocks. Which stocks have had the expectations perhaps put on them that are extremely high? We've seen a few companies report earnings already or talk about earnings, and they were fantastic, yet their stock prices fell once they announced those results. So we're going to get into those names and some others. Expect more volatility in the second half. I think that's important for individual investors to understand or realize. I think there is potential for there to be as much volatility as we've seen in the first half of this year in the second half, or perhaps even a little more. And I will talk about a couple of reasons why I think that is. So let's move to our first topic, which are oil prices continue to climb. And yeah, it's been an interesting run for oil. We saw in June oil prices come down quite a bit once a ceasefire was announced, that the United States was going to give Iran a period of time which they can negotiate things such as giving up their enriched uranium so that they could not proceed with a nuclear weapon. And in return, they also allowed for certain concessions for Iran. Iran was going to also open up or allow tankers and vessels to go through the Strait of Hormuz and allow energy and many other things to get to the rest of the world from that region for in the world, the Gulf states, Arab nations. We saw, we know things such as fertilizer and other things need to get out from that region. Not to, of course, oil is the number one, but 20% of the world's oil comes through the Strait of Hormuz. So Once that was shut down once again, we started to see oil prices climb. And as I've written down here, oil prices before I came on air this afternoon, $87 a barrel on WTI. Brent crude back above $90 a barrel. We saw it over 100 briefly, then back down to under 70, and now once again getting close to $90 on WTI. So, what does that mean for things such as gasoline prices and other things? Well, let's take a look at our charts. Our first chart shows oil prices, WTI Brent oil prices, and both of them are there. You can see, there you go. WTI, I can tell you now, is, as I said, above $87 a barrel, and Brent crude is now above that $92 a barrel price. We are tracking U.S. gasoline prices, our next chart. And it's a great chart. You can see the ups and downs. There you have February 28th, U.S. and Israel initiate strikes on Iran. Look at the spike. Look at the spike in gasoline prices, and then look at the retracement of those gasoline prices. And you can see on the far right-hand side, back above $4 once again. So very, very volatile gasoline prices. We take a look and we say, hey, well, we live in Canada and I'm broadcasting today from Toronto. What's going on in Toronto? How are the price at the pumps in Toronto faring? Our next chart shows you gas prices in Toronto and how they've done. And you can see, even though we are the fourth largest producer of oil, of energy and oil in the world today, the United States is actually the largest producer. We're not immune, and neither is the United States, to what's going on in the Middle East. And we're seeing our gasoline prices now dollar 80 right now approximately, and on the rise. Another chart that we have is about exactly why these gasoline prices are rising, why oil prices are rising, and that is the ships coming out of the Strait of Hormuz, as I mentioned a few moments ago. And our chart there shows Strait of Hormuz vessel traffic rebounded in June. You can see there spiking up to 77, vessels getting through the strait, much higher than what we saw in the months of March, April, and May. At the end of June, up to 77, but now look at it come crashing down as low as 13 vessels. And I can tell you that it's even lower than that now. Some are saying that very few are getting through. A lot of them turn off their transponder so that they cannot be detected as they travel through the strait. So maybe we see a few ships getting through, but definitely now below 10 or into the single digits. And that is just not good for the price of oil. Our next chart talks about the strategic reserve that all countries have. The U.S. Strategic Petroleum Reserve falls to its lowest levels since 1983. That is over 40 years ago. Strategic Reserve now is getting close to 300 million barrels. Still sounds like a big number, but look where it used to be. It was well over 700 million barrels not that long ago. Just maybe in 2017, 18, it was around 700 million barrels, and really started to come down after, I would say, 2021, and started going up a little bit in 25, but now coming down once again as the U.S. taps into that strategic petroleum reserve. Next chart I have is actually one of my favorites for this show. It clearly shows the relationship between oil prices and U.S. inflation. There you have it. So interesting enough, you see U.S. oil prices starting to spike higher in February, but really going a lot higher in the month of March. That was when the war in the Middle East, or the conflict, broke out. And you see a lot of up and down, and then coming down in June when that memorandum of understanding was signed by Iran and the U.S. to cease hostilities for a period of time so they can continue the negotiations. As we now know, that did not lead to what the U.S. wanted the enriched uranium, wanted them to stop the idea of getting a nuclear weapon. Iran seems to be stalling the United States. President of the United States, I guess, at some point got a little bit angry, and the hostilities have renewed, and the bombs and the missiles are flying once again. On the right-hand side, you can see U.S. CPI moving higher with oil prices, then coming down in the month of June. What you don't see is the part where Brent crude and WTI have now spiked higher, and many people believe that you will now see U.S. CPI spike higher as well. That's why it is so important when the Fed talks about core CPI, that strips out volatile energy and food. And I think that is the main number that the Federal Reserve looks at before they set interest rate policy. It's the main number that the Bank of Canada looks at as well. So hopefully we can continue to see core CPI readings remain relatively low. If we start seeing things move higher there, that could be the recipe for central banks to start raising interest rates. So oil prices, got to keep an eye on oil prices if you are an investor. Our next point that I wanted to stress or talk about is this idea of our expectations for certain stocks. Did they get out of hand? Well out of hand? Are they too high? And we've seen this because we've seen some excellent reports, and we saw one most recently out of Samsung Electronics, very large company out of South Korea. They came out with their preliminary earnings on July 7th. They were unbelievable. Understanding that this past quarter, what they told us on July 7th, the amount of business, the amount of growth they had in this last quarter rivals the last 2 years put together, 2024 and 25. Unbelievable. Numbers that we have not seen before. And what happened on the day they came out with their preliminary results? Samsung stock dropped in value. Why is that? Because expectations have just gone too far, too fast, too high. The expectations are almost unattainable, in my opinion, and that's what we saw. And we're seeing it out of companies like Samsung. We see it out of companies like Taiwan Semiconductor. They most recently reported fantastic earnings as well, only to see their stock drop. And then good news is it's moved higher most recently. So our first chart that we have is a chart of Samsung. It is a 3-month chart. There you have it. And you can see time period July 7th. Look at that downward slope that we saw in Samsung. We saw recently an uptick in the share price, which is great. Samsung is set to report earnings, official earnings, at the end of July. Taiwan Semiconductor, our next chart that we have, you can see here, they also came out with earnings, but look at that steady, slope downward in the month of July. Taiwan Semiconductor reported fantastic earnings. They keep, increasing earnings. They're increasing spending. They keep talking about how good things are, all the plants that they're now building in the United States and how much they are growing. It's unbelievable. Yet stock price fell. Again, are expectations too high? Something to keep in mind for some or certain stocks before you buy them. Another one of our favorites for a long time, NVIDIA. We have a chart of NVIDIA. Look at the NVIDIA chart. Look at it from the period of about July, August of last year to about April of this year. Stock really went nowhere, yet they just continue to dominate with respect to market share. Their margins are still mid 70%, growing earnings at 80%. Just unbelievable numbers. But maybe, just maybe, individual investors are saying maybe this is as good as it gets. How much better can NVIDIA do? And that's a fair question. How much higher, how much more money can they make? How much more revenue can they generate? Market share dominance. We can guess that their market share will come down as more and more companies build out or create their own chips. But it's just unbelievable to think that NVIDIA stock has gone absolutely nowhere. We saw a spike up in the month of April, as you can see on the chart, but then came right back down in the month of June and July. It's kind of struggling, right? We saw NVIDIA reach these prices about a year ago and really haven't done much as of yet. Next chart that we have for this segment is one for Apple. And this is an interesting one. And Apple's going to report earnings in the next week or so. And the interesting thing about Apple is this. Look at the run-up that we've seen in the stock heading into earnings. And it's something that gets investors nervous because I guess people are anticipating that earnings will be good. Now, Apple's a little different. I like Apple stock. I think it's a great opportunity to perhaps look at Apple as an opportunity to buy. And I do that because they haven't really embraced AI in their products as yet. And we've now started to hear that it's coming. And when it does come, how much better will their products be? Perhaps people will convert over for those that aren't in the Apple universe. they'll start to buy Apple products once they embrace AI a little bit more, put it more into their phones and laptops and etc. So I think there's a bright future for Apple. But when you head into an earnings report with a jump in stock price like Apple has, it gets people nervous. On the flip side, our next chart, which is of Microsoft, look at the chart of Microsoft. Now they're heading into earnings, and look at that chart. Pretty ugly, if you ask me. Yes, Microsoft has moved higher recently from about, before I'd say at the end of June, the stock was trading at around 360-ish, $370 a share. Now it's just under 400, but a far cry from where it used to trade, well over $500. $555 was its high. So you got to be careful when you look at these stock ideas. There are a lot of names right now that are pricing in a lot of good news, a lot of good reports coming up this earnings season, whether it's tech, whether it's names outside of tech. And I think that should affect the type of decisions you make when you go to, fill out your portfolio or buy new names in your portfolio. Are the stocks you're buying, are they cheap or are they priced to perfection? And perhaps you may want to stay away from those names. Our third and last point, it is with respect to what you should be considering before you make your investment decisions. And this is the idea of expecting more volatility in the second half. Now, I don't want to scare anybody. In fact, I want to talk about what I think is going to cause the volatility so that when it does happen, you could say, well, this is expected. This is not going to get me to sell out of all my investments and go to cash or do something out of panic. And so when I talk about that perhaps we could see maybe even more volatility in the second half, this is to get everybody prepared for the possibility of that volatility. And first thing I want to go into is seasonal factors. Our first chart shows the monthly return stats for the S&P 500, 1964, 2024. So we know September, we talk about this on the show all the time, is one of those months that the market just can't seem to gain traction. We've seen in the past, on average, September tends to be a bad month. We are headed towards September. Usually August is a bit soft, getting into leading towards September. So be prepared perhaps for a soft September. We also, our next chart shows that we are in a midterm election year. And what happens during midterm elections? The year two of a presidential term, we tend to see an underperformance of the stock market. Stock market doesn't perform as well as other years. Look at next year. Market tends to outperform significantly. So perhaps we have a bit of a bumpy ride because of the midterms this year, but heading into next year, things look a lot better, at least historically. And last but definitely not least, of course, we would talk about or add the fact that the Middle East conflict is now kicking into a higher gear right now. As I said, that could raise prices for oil, which could cause interest rates to rise, which could cause inflation to rise. Not good for the economy and not good for the stock market. So I would say look for perhaps volatility to increase. Yes, increase, unfortunately, in the second half of this year. And those would be a few factors to consider before you make your investment decisions. Market sell-offs, we've seen a bunch of them throughout the course of the last few years. The darlings of the market, the Mag 7, the Magnificent 7, the 7 biggest tech stocks in the world today, they used to run the show. They used to be the stocks that drove the bus and drove the market higher. We saw a sell-off in those names. And what followed was a run-up in a lot of these chip names, the semiconductors. And then we've now recently seen a bit of a sell-off there. And that's the sell-off I want to focus on today. Sell-off in some of these chip companies that have led the market for the last, let's say for at least since the end of last year and into, I would say, the summer of this year. We've seen names like Micron and others really begin to sell off. And I think it's just simply because people are thinking what goes up as fast as it has must come down at some point. It is very difficult for these companies to keep their, their pace of growth. And so individual investors have been starting to sell some of these chip makers, these memory chips, chips for companies that do servers and chip equipment companies, Lam Research, Applied Materials. They started to sell these companies off. Our first chart clearly shows this. Chip stocks fall in bear market, into a bear market. Some of these stocks have fallen over 30%. Micron is one of them, SanDisk, Western Digital, all these names, once the darlings of the market. Lam Research, as I said, a chip equipment company, Dell Technologies, they do computers. We all know Dell computers. Well, they do servers, AI in their servers, and they've been reaping the rewards of company spend on infrastructure and servers, and they've seen their stock price really move higher. We've seen all these names begin to sell off. And again, I think it's just because people are saying what goes up fast must come down at some point. Our next chart shows the hyperscalers. As I said, hyperscalers are your Mag 7 names for the most part. Your Amazons, your Metas, your Microsofts. And we saw these names sell off. They're the yellow line. And why they sold off was because of the spend. They were spending, and they continue to spend billions and billions of dollars, hundreds of billions of dollars. The number I've seen for 2028 will be over $1 trillion of spend on data center infrastructure, on AI in general. And you can see the interesting the lines here. One is the cash flow for these hyperscalers or the big cap tech names. You can see the cash flow is dropping because these companies are spending so much money. And where is that cash flow going? Well, it's going into the chip equipment makers, the semiconductors, and you can see the purple line going straight up. So it is the chip companies making all the money, and it is the hyperscalers or some of the big cap tech names paying for that, or even as much as borrowing money. We've seen companies like Amazon borrow money recently to buy more and to spend more on AI. I don't think that is a recipe for success over the long term. But now we will go to a couple of charts, specifically Micron. I wanted to show, I mentioned it already. Micron stock, there you have it. What a run up that we saw really for a little while now. And now we've seen a sell off again. Is Micron pricing in perfection? Perhaps expectations are high. I just think individual investors are starting to sell the name. But keep in mind, Micron only trades at 13 times forward earnings. Very, very cheap, which tells everybody that their earnings are growing faster than the price of their shares are growing. So perhaps it's a name we circle back on for many investors. May take a look at that once again. SanDisk, our next chart. That company, a little bit more expensive than Micron, trading at around 24 times forward earnings. But you could see, again, a bit of a sell-off in SanDisk and their shares. Lam Research, chip equipment maker. We've seen this stock fall as well. This stock not so cheap, 50 times forward earnings, so still quite expensive. A name that I think many people are shying away from just because it's so expensive. Our next stock, Oracle. Let's take a look at the stock or graph of Oracle. Oh my goodness, look how much Oracle has fallen. Now, they have a different problem. I don't think the expectations are too high for Oracle. In fact, I think the expectations are quite low. And they've been falling because of how much money they have been spending, that they've been borrowing to build out data center and provide the infrastructure for data centers. And so everybody's a little bit nervous. What happens if these data centers don't get built? What happens if companies cannot pay Oracle, like an OpenAI or others? Oracle will be on the hook for a lot of money, and people are getting nervous. Their actual bonds are just one notch above junk rated bonds. And that is not good. If they go into junk status, that would be not good for not only the bonds, but also for the stock. Meta Platforms, our next chart, similar. They continue to spend a lot of money and they continue to be punished for spending that money. Although we do see that Meta recently said that a lot of the money they've been spending on is this whole idea of creating more compute for companies to use. And if they start to sell that extra compute, that will be a lot of profits for the company. And that's why the shares have moved significantly higher. So we've seen a lot of people selling Oracle, selling Meta at one point, selling Micron. Where's the money going to? Well, I can tell you a couple of places it's been going to. First and foremost, JP Morgan. Let's take a look at a chart of JP Morgan, largest bank in the United States. Look at that chart. I would say money's going into JP Morgan stock and shares. A lot of people think JP Morgan is still cheap to own today. Bank of America, our next chart. Similar type of chart, maybe even better, maybe even a steeper incline there. A lot of money going into banks, financials. We've seen money going into Canadian banks and Canadian financials as well. Our next chart, one, United Health, another area, healthcare stocks, pharmaceutical companies. this is also where money's been coming out of some of the tech names and going into some other names. And again, making the case for diversification. We need to be diversified, and owning some shares of United Health or our next stock, CVS Health, another great chart. You can clearly see that money's flowing into the healthcare area. Not something we've seen a lot of over the last little while. Money coming out of tech and moving into financials, pharmaceuticals, maybe even a few retail names, maybe some names on the defense side. So definitely making the case for diversification. We're seeing the sell-off in some of these chip names, but as I said, I think some of these names we could circle back on. So as an individual investor, I think you want to be mindful of these names, what's going on, and the valuations. Are these companies that are being sold off? Is the sell-off justified based on valuation? And look and follow where the money is going. And that, in my opinion, is what individual investors should be doing with some of these sell-offs. Wanted to go quickly through some of the tech names that I'm going to be watching over the next few days. A lot of companies going to report earnings. And some tech names, as I said off top of the show, I'm going to be giving you a lot of different stock ideas today, some good and some not so good, and some we're just not sure if they're good yet. And that would be starting off with our first tech name that I'm going to be watching, which is Alphabet. Alphabet, we all know it as Google, but the parent company is Alphabet. Google search is just one part. Obviously, they have their chip making abilities, they have their search, they have their driverless cars as well, their Waymo. So there are a lot of parts to Alphabet. We're going to be watching tonight after the bell, after 4 o'clock, to see what Google has to say. It is a juggernaut. We're going to need to see if search can continue to grow, if its cloud business can continue to grow. It's been doing phenomenally well, growing well above 30%, getting close to 40% growth on its cloud business. Can that be maintained? Next chart that we have is a gain of Microsoft. We're coming in with really low expectations for Microsoft. How is Copilot doing? What are they going to say about Azure, their cloud business? We know it's growing at around 40% clip, which is phenomenally well, but they're going to need to do something. They're going to need to tell us something on the positive side that we're not expecting. We know Microsoft is considered by many accounts a software company. And we know what software companies have done over the last little while with AI. We're going to need to see something really good out of Microsoft. They will report in the coming days. Amazon, another name that we all love. We can all, I think I ordered something from Amazon yesterday, and I'm being told my package is going to be delivered today, which is unbelievable. I think we're all used to the Amazon way of life. That's just one part of the business. They have their AWS, which is their cloud business. They have their titanium chips, which they're now building and people and companies are using for their businesses. What are they going to say about earnings revenue? We know they're borrowing a lot of money. What are they going to say about their debt that they've been taking on? It's a name I think that we're going to closely watch. Meta Platforms, our next chart. We already seen the chart of Meta earlier on the show. What are they going to say to us about their spend and their extra compute that they're going to be selling to other companies? So these are some of the names that I'm going to be watching. Obviously, tonight we have other names that are important as well. IBM is coming out with earnings, although they did tell us that things will look a little soft. But we want to see what IBM has to say on the call today. Texas Instruments, another chip company, they put chips into more ordinary type, I say ordinary, run-of-the-mill type of things, such as calculators and other devices that we use on a daily basis. So the chips are a little bit more used than some of the other chips out there. They also use their chips in automobiles, etc. So we'll see what Texas Instruments has to say as well. So a lot of tech names going to be reporting over the next week or 2 weeks. NVIDIA doesn't report for a little while. That would be the biggest one coming up a little bit later. But we need to keep an eye on these tech companies and what they have to say. And that definitely will be market moving over the next week. Quick hits, 3 things that I've seen in the news over the past couple of weeks that I wanted to comment on. First one, Carney says new tariffs that the U.S. is now threatening to put on. I think they're giving us 30 days before they implement the tariffs. in violation. It's in violation of the agreement of Kuzma, but agrees to intensify negotiations after a call with the president. I think these tariffs, whether or not they happen, I'm not sure. I would be surprised if they do come through, but I think it's just a way to get Canada perhaps to start to intensify negotiations, and it looks like we are doing that. Number two, Mexico not looking to cut side deal with the US and leave Canada out. That's great to hear. We know that Mexico has been talking to the United States, and it is good that Mexico does not want to leave out Canada in the negotiations. Our third point, voters wary of government ownership in companies as Trump administration takes equity stakes. They've been doing this now for a little while, putting government money into certain companies. So basically picking winners and losers, which companies they want to prop up. And obviously, when they do invest money into quantum computing companies or companies like Intel or some of the rare earth material companies, obviously the stocks or the share price of those companies move higher. So let's move to our first quick hit. Carney says new tariffs are in violation of Kuzma. And I guess this is a bit of a quote that we have. We can pull it up here. Defending American workers and ensuring fair trade. Today, President Trump signed 3 proclamations pursuant to Section 338 of the Tariff Act of 1930. He's gone way back to get these things put through, imposing an additional 50% tariffs on certain goods out of Canada in response to Canada's discriminatory treatment of American products. By doing so, President Trump is offsetting the burden and disadvantage on the U.S. commerce from Canada's discriminatory treatment of U.S. commerce and is leveling the playing field for crucial American exports such as cars, alcohol, and dairy products. I know the United States is not happy with our supply management, but as I said, and the piece goes on to explaining more things, but overall, in my opinion, I think this is a way that President Trump wants to get negotiations moving in what he would feel in a better direction, and sort of forcing the hand of us here in Canada to come to the negotiating table and actually maybe make some concessions. I believe we've already made some in the past, but we might have to make a few more. Our second quick hit talks about Mexico not leaving Canada out. And our one segment, or I should say one illustration for this segment, talks about countries with the highest percentage of trade with the United States. You can see Mexico just under 17%, Canada just under 13%, and everybody else is a fair bit away. Canada's top trading partner with the US. It's not the biggest trading partner, or I guess their most important trading partner, but it is the second most. And the fact that Mexico, Canada, and the US continue to negotiate a trilateral type of agreement, that is important for the success for Canada's negotiations. Our third quick hit talks about what the U.S. public thinks, what Americans think about the U.S. picking winners and losers, which companies to invest money in. And our one chart, or I guess illustration for this, shows that 49% do not agree with the United States picking winners and losers and investing money into publicly traded companies. They are just picking ones that they want to prop up versus ones that maybe they don't want to prop up. 32% are saying it is, they have no opinion, and only 19% think it's appropriate. So 3 things in the news that I wanted to comment on that I think is important and caught my eye. Obviously, the new possible tariffs of 50% is the one I think on everybody's minds here in Canada, but we'll have to see if that is just another negotiating tactic or will actually come to fruition over the next 30 days. What's my take? This is the part of the show where I take one question from our audience. And today's question came from an investor that frequently watches our show. And he really wanted me to address this question. It actually came to me just yesterday and kind of summarized it for our show. There is a negative talk from some people that the market upswing won't last. Is a market crash a possibility? What would need to happen for a crash to occur? And if the market does fall, how large could the fall be? And wanted to address this because I too have been getting some articles from clients, from investors that they've been reading that basically says what goes up must come down, and that we are primed for a big fall in the markets, a very big fall. And I kind of want to take a step back to address this because I think it's very important to address it. Number one, we have seen a very big fall in the markets recently. One happened, 20% fall in the S&P 500 last April when President Trump introduced his tariffs to the world. So we have seen a big fall. We tend to see a couple of falls between 5 and 10% on average every year. We saw one most recently in March when the war broke out in the Middle East. Markets fell 7%. Last year we saw a few falls in the market. And when you go back in history, back to 1987, the one-day crash, you can go to 1999, tech bubble bursting, 2008 financial crisis, 2011 when some European nations had outstanding debt, Greece. We saw also at that time US lose their AAA rating. We've been through COVID in 2020. In 2022, interest rates rose 10 times. We saw the S&P 500 fall well over 20%, the largest or the fourth largest fall in since we've been keeping track in history. So we've been through a number of big falls. Yet, where is the S&P 500 today? Where is the Dow Jones today? Where is the TSX today? At all-time highs. So my message to everybody who is trying to predict this great crash and when it's going to happen, I think you better rethink about what you're doing. And a lot of people are saying a fall is going to happen, a fall is going to happen. And it may take 1, 2, 3 years. And then one day the fall does happen. And they say, you see, I was right. But how much money do those people or did those people leave on the table in the meantime? How much money or how much did the market go up and then pull back? So the market goes up 30, 40, 50%, then it pulls back 15%. Well, the market, guess what, is still up 35%. So you have to be careful. You know, as they say, the end of the world is something that is predicted many times, but it obviously can only happen once, and it hasn't happened as yet. So if you're an investor today, my message to you is very simple. Yes, a fall will happen. Absolutely. They always do. The market is extremely resilient. It constantly climbs that wall of worry. We will see 5 to 10% corrections. We will see at some point a 10 to 20% correction, maybe at the end of the year, maybe early next year. It will happen. But this market is strong if you own good quality investments, leaders in their field, leaders are in their sector. These are the companies that bounce back from any fall. They fall the least amount and they then thrive on the other side. So if you're an investor that has read a doomsday scenario over the past little while, put that on the side. Understand that, yes, markets will fall at some point. If you're an investor just getting into the market, you've already seen some volatility over the past 2 to 4 weeks. Markets go higher over time. We see it time and time again. As I say, if this was a game investing, and it's not, but if it was, it would be the best game in town because everybody's a winner long term. So with that, I want to say thank you to everybody who tuned into our show today. Hopefully, some of you had your pencils and pens ready as I spoke about many different stocks, showed you many different charts. Hopefully, so all of you will take away something from our show. I want to thank all of you for tuning in, whichever social media platform you're tuning in on. And I want to say that we will be back on air 2 weeks from today on August the 5th at 12 noon across all social media channels. And until then, happy investing.